On June 1st, 2023, after much anticipation and a lengthy debate on whether the United States of America would default on its debt, the nation has made a significant move by suspending its debt ceiling, effectively averting a default. While many may believe that this resolves the U.S. default concern, it's crucial to recognize the profound implications it carries, the weakening of the U.S. dollar and the impending risk of the nation's economy teetering on the verge of collapse. Though by now you've known how the debt ceiling would have prevented the slide of the U.S. economy, this indication of the U.S. falling into the crisis started in May when the U.S. government sells its BTC holding, according to the reports. The experts say that the Bitcoin market has experienced volatility fluctuating within the range of $30,000 and $27,000. Unexpectedly, on May 11th, Bitcoin experienced a significant drop below the lower threshold and reached $26,723, representing its lowest point in nearly 2 months. This downward movement came as a surprise, especially considering the temporary increase in Bitcoin's price following the release of U.S. inflation statistics on May 10. These unconventional movements of stocks had already predicted the shortage of the fund by the governments. Though no official statements have come from the government and 9 accounts related to the government had showed no transactions have raised an eyebrows of their investors. But over the years, the U.S. government has accumulated a substantial reserve of Bitcoins. These digital coins were acquired through various means, including seizures from the Silk Road marketplace, crypto thefts on the Bitfinex exchange, and the case of James Zhang. In 2012, Zhang admitted to manipulating the Silk Road transaction system with the intention of diverting Bitcoins for personal gain. So how did the U.S. debt ceiling deal affect us all, and how crypto would have or will play a crucial role? Before hoping on those answers, let's know first what the U.S. debt ceiling deal is. Chapter 1. What is the debt ceiling? What's in the deal? The United States has a debt ceiling law that sets a maximum limit on the amount of money the government can borrow to fulfill its financial obligations. These obligations encompass various expenditures such as federal employee salaries, military expenses, Social Security, Medicare, interest on the national debt, and tax refunds. Periodically, the U.S. Congress must vote to increase or suspend the debt ceiling in order to allow for additional borrowing. The current cap stands at approximately $31.4 trillion. Although this limit was surpassed in January, the Treasury Department employed extraordinary measures to provide the government with additional funds while determining the next course of action. Traditionally, it's been a customary procedure for Congress to raise the debt limit when necessary. However, in recent years, as political polarization has intensified, the two major parties have struggled to reach a consensus on the terms of such an increase. Treasury Secretary Janet Yellen has issued a warning that without further borrowing, the United States will face a shortfall of funds to meet its financial obligations as early as June 5th. So what's the deal with the existing law? In the previous month, the Republican Party presented a proposal aimed at maintaining spending for crucial government agencies at 2022 levels for the upcoming fiscal year. The plan also sought to restrict annual growth to 1% over the next 10 years. If implemented, this proposal would have repealed significant priorities outlined by the Biden administration, including initiatives such as student loan forgiveness and tax incentives for electric vehicles. Additionally, Republicans aim to introduce stricter work requirements for individuals receiving health care and food welfare benefits. While the Republicans did not achieve all of their desired outcomes, the Democrats under Mr. Biden did not secure all of their objectives either. The resulting agreement entails a freeze on non-defense budgets for the year 2024, followed by a 1% increase in the subsequent year and no budget caps beyond 2025. So that means the downfall of the U.S. economy will be prevented. No. For now, things seem to be sorted out, but in the upcoming 10 years, if the U.S. government keeps on taking loans from external assets like the World Bank, International Monetary Funds, Development Bank, or wealth funds, commercial banks, bilateral loans from other countries, or bonds and fail to repay the amount, then the chances of downfall on the U.S. economy is 100% as per the experts. And why there's a possible chance of this situation? For that, look at this chart. The existence of the debt ceiling serves as a signal that the United States may be assuming an unsustainable level of debt, and this is not a recent development. The concept of the debt ceiling dates back to World War I, during which the U.S. debt skyrocketed from 3.5% to a staggering 30.2% of its GDP. A similar pattern emerged in World War II, with the debt-to-GDP ratio reaching 103%. However, following the war, there was a significant decline in the debt-to-GDP ratio, dropping to a mere 35.2% in 2007. Unfortunately, the 2008 recession marked a turning point as the debt-to-GDP ratio began to rise once again. The COVID-19 pandemic further exacerbated this trend, pushing the U.S. debt-to-GDP ratio to 98.2% and now nearing 134%. This substantial increase can be largely attributed to a 50% rise in U.S. government expenditure during the financial year spanning from 2019 to 2020. Surely the U.S. government has failed to spend within the boundaries of the loan taken in any form and could possibly be outcrashed by the other global leaders who are ready to take charge of the world economy. For further details on why this scenario could be possible, you can click on the link above and watch our video on why the world is ditching dollars. You can also go to the description to watch out the videos. Coming back to the video, the speculations are many, and the environment is not favorable to the U.S. government, but the experts have seen upon to the reliability of the digital currencies like crypto and bitcoins. We'll see every possibility related to that at the end of the video. But the real question that arouses here is, could a U.S. debt default trigger the global nightmare for us? Chapter 2. The current situation in the U.S. government regarding the debt ceiling has led to what could potentially be one of the most costly standoffs in history. Failure to reach an agreement between Democrats and Republicans on raising the debt ceiling could result in the world's economy defaulting on its $31.4 trillion debt. The deadline for reaching an agreement is approaching on the ominously labeled X date of June 5th. While experts consulted by the BBC do not believe that the U.S. would actually default on its debt, the consequences of such an event would be severe. Simon French, chief economist at investment bank Panmure Gordon, suggests that a default would make the global financial crisis of 2008 seem mild in comparison. Without an increase in the debt ceiling, the U.S. would be unable to borrow additional funds and would quickly exhaust its resources to fulfill public benefits and other obligations. This would lead to a halt in welfare payments and support, impacting people's ability to spend and pay bills, ultimately affecting the overall economy. The White House Council of Economic Advisors estimates that a prolonged failure to reach a debt ceiling agreement could result in a contraction of the economy by as much as 6.1%. Economist Mohad El-Arian warns that the default would likely push the U.S. into a recession. The consequences would not be limited to the U.S. alone, as the U.S. is a major trading partner for many countries. A default would have significant ripple effects on the global economy. Additionally, a U.S. default would cause mortgages in other countries to become more expensive and could lead to increased unemployment. The failure of the U.S. government to repay its debt or interest on bonds would raise concerns among investors, potentially increasing the interest rates demanded for purchasing government debt. This would have a cascading effect on mortgage rates and all forms of borrowing, making them more costly for governments, businesses, and individuals alike. The value of the U.S. dollar, which serves as the world's reserve currency, would also be expected to plummet in the event of a default. This would create uncertainty among investors, affecting the pricing of commodities such as oil and wheat, leading to higher prices for essential goods like bread and fuel. The impact on pensions is another area of concern. Given that the U.S. accounts for 60% of the value of global stock markets, a default would likely result in a negative reaction from stock markets. This could affect pension plans heavily invested in U.S. shares, potentially leading to short-term losses. However, historical precedent suggests that stock markets tend to recover relatively quickly from such shocks. While the consequences of a U.S. default are dire, it's important to note that similar situations have occurred in the past and last-minute agreements were reached. It remains to be seen how the current situation will unfold, but it's hoped that a resolution will be reached to avoid the potentially catastrophic implications for the global economy. So if there's a minute possibility to the situation in the future, then what will save from this? The digital currency. Chapter 3. How crypto is and was the best option to tackle the current situations. Central bank digital currencies, CBDCs, are designed to provide increased resilience, safety, availability, and cost-effectiveness compared to private digital money, including volatile cryptocurrencies. Around 100 countries are exploring CBDCs, with some already distributing them to the public, such as the Sand Dollar in the Bahamas and China's digital renminbi. The Federal Reserve acknowledges the potential transformative impact of CBDCs on the U.S. financial system. The IMF supports CBDC developments and promotes interoperability among countries. CBDCs can address unique circumstances, serving as a tool for financial inclusion and providing a backup for failed payment instruments. Central banks prioritize financial stability and privacy, implementing non-interest-bearing CBDCs and limits on holdings to prevent disruptions and address privacy concerns. Privacy considerations and a balanced approach to design and policy are crucial for successful CBDC implementation. Trust in credible central banks is essential for CBDC success as they continue to facilitate economic transactions as a public good. In response to the declining U.S. economy and the increasing adoption of virtual currencies, the New York Federal Reserve Bank and other major banks initiated a 12-week pilot program last month to test a digital dollar. While this move represents progress in the central bank's rollout of digital currency, concern has been raised by experts and activists regarding its potential, particularly in terms of making banking more affordable. The pilot program is part of a broader series of steps taken by the central bank, which align with the introduction of the eCash Act in March. Proposed by Representative Stephen Lynch of Massachusetts and co-sponsored by 3 other Democratic lawmakers, the bill aimed to prompt the Treasury Department to explore the implementation of a government-issued digital currency. However, the bill did not pass in either chamber. Answar Prasad, a trade policy professor at Cornell University, highlights that the use of physical currency is diminishing in many economies, with cash becoming increasingly obsolete. Prasad predicts that even in the United States, there will come a day where currency is no longer used. However, some doubt remains regarding whether a digital currency will effectively address concerns such as affordability in the banking sector. The implications of the United States suspending its debt ceiling and the potential downfall of the U.S. economy. It highlights the risks associated with the increasing debt-to-GDP ratio and the inability of the U.S. government to spend within its means. The potential consequences of a U.S. default on its debt are explored, including a global financial crisis, economic contraction, increased unemployment, higher borrowing costs, and a devalued U.S. dollar. And that brings us to the end of this video. We've delved into the intricacies of the U.S. debt ceiling, explored the potential consequences of a default, and discussed the role of digital currencies in tackling these challenges. It's clear that the U.S. economy is at a critical juncture, and the decisions made in the coming years will have far-reaching implications. While there are concerns and uncertainties surrounding the future, one thing remains certain: change is on the horizon. The digital revolution is transforming our financial systems, and cryptocurrencies like Bitcoin are reshaping the way we perceive and transact with money. The pilot program for a digital dollar is a step towards embracing this transformation and exploring the potential of digital currencies. As we move forward, it's crucial for policymakers, economists, and individuals to engage in informed discussions and decision-making. The road ahead may be challenging, but it also presents opportunities for innovation and progress. Will a digital currency truly address the concerns of affordability and financial stability? Only time will tell, but be ready for the doomsday that could come in the near future. We hope this video has provided you with valuable insights and provoked further thought on the future of the U.S. economy and the role of digital currencies. If you enjoyed this content, don't forget to like, subscribe, and share with others who may find it interesting. Thank you for watching, and we'll see you in the next video.